U.S. natural gas futures climbed nearly 5% on Wednesday, settling around $3.46, as stronger flows to LNG export facilities provided short-term support. Average feed gas deliveries to the 8 largest U.S. LNG terminals have risen to 18.3 billion cubic feet per day so far in February, up from 17.8 billion cubic feet per day in January and approaching December's record of 18.5 billion cubic feet per day. This steady pull from the export sector continues to act as an important demand backstop for prices. From a fundamental perspective, however, the broader backdrop remains mixed. Weather forecasts call for mostly warmer than normal temperatures through February 19, particularly across the western half of the United States, where anomalies of up to 30 degrees Fahrenheit above seasonal norms could sharply reduce heating demand. While the Northeast is expected to stay below average for another week, even that region should see relief as Arctic air retreats back into Canada. On the supply side, lower 48 production has edged up to 106.4 billion cubic feet per day in February, slightly above January levels, suggesting producers are maintaining strong output despite recent price volatility. Meanwhile, storage dynamics remain a near-term focal point. Analysts estimate that last week's Arctic blast drove heavy withdrawals, flipping inventories from roughly 5% above the 5-year average to about 1% below normal. This keeps some immediate supply tightness in the system, but with winter fading and production holding firm, the market is increasingly questioning whether the much-feared supply crunch was overstated. Technically, the market continues to stall around the $3.25 to $3.50 zone, reflecting a lack of sustained momentum. The $2.90 level still looks like a solid floor, supported by residual winter demand in LNG exports. On the upside, recent rallies have struggled to extend, suggesting that buyers are becoming more cautious as the calendar moves closer to spring. Without a renewed cold weather catalyst, upside breakouts are likely to be limited and short-lived. Looking ahead, the risk profile is shifting. If winter ends on a mild note, after an already volatile and at times harsh season, storage levels could remain relatively comfortable heading into the shoulder months. While another weather-driven pop is still possible before winter fully exits, it increasingly appears that the highs for the season may already be in. A return to extreme levels such as $4.30 seems unlikely under current conditions, barring a major and unexpected shift in weather patterns. With the April contract roll approaching around February 25, the window for a meaningful winter-driven rally is narrowing quickly. Traders are not yet aggressively shorting, but many appear willing to sell into any additional bounce, positioning for weaker demand in spring and early summer. In that sense, time is becoming a critical factor. If prices are going to surge again, it likely needs to happen soon, or not at all. If you found this helpful, consider buying me a coffee or watching ads to support the channel and keep the content coming. Thanks for the support, and I'll see you in the next one.